All right, welcome back, everybody. It's Brian Strain here. I've got a few questions that came in, and we're going to talk about all of them. One of them came in by the community, so if you were paying attention to the community today, you probably saw the question, and I want to cover that one first. He's asked, I have an open credit spread on TPX. This morning, huge drop on the chart because of a stock split. What should I do with my credit spread? So this brings up a situation. We haven't talked about this in some time, but it brings up a situation. If you have a credit spread and a stock goes through a split, what do you do? Well, the part of that he's asking, what should I do? I can never answer that question, just so you know. I'm never going to ever tell you what you should do. All I'm going to tell you about is what your options are and what the math and what our research tells us, and then you get to decide. Okay, that being said, let's go into Odds Online and look at TPX. So this is a mattress company, Tempur-Pedic Sealy. So the first thing I want you to notice is the stock price is pretty near 100. It's close. It's not. It's a little bit above at 102.58 as of the close yesterday. So the first thing we got to do is figure out what the stock split is. So Odds Online, this data that we're seeing right here is always pre-split adjusted. So if there is a stock split, the stock price is going to get adjusted. And the first thing that we got to do is figure out what the terms are of the split. So we can do that by going up here and clicking to the news. And you can already see right here, the price on Yahoo doesn't match the price in Odds Online anymore. And if you look at that price, you can figure out pretty quickly this is a 4-for-1 split. But I want to be sure, so I'm going to go check the news. I'm just going to scroll down until I see a split announcement. There it is, right there. And it tells us Tempur Sealy rose after the mattress maker posted better than expected earnings, and they approved a 4-for-1 stock split and raised its buyback plan. So in order to find out the details, because that tells me it's a 4-for-1 split, but it doesn't tell me the date. Now, just because I looked at Odds Online and saw the price at 100 and looked at Yahoo and saw the price at 25, I could tell that it was a 4-for-1 split, and it probably happened overnight. So something that happened yesterday after the market closed is what my guess is. But we could go find that out by reading the article and finding out the details. Looks like it has a lot of information here about earnings. The stock split is payable November 23rd to holders of record on November 10th. So what happens in a stock split? We've got to decide that. So we've decided that this happened sometime yesterday after the market closed because these prices don't match. And it said the 23rd, today's the 24th. So yesterday was the 23rd. It happened after the market closed because our data from yesterday says the stock price is at 100, or around 100. So when we go back here, what happens when the stock splits? So in a 4-for-1 split, for every one share you have, you're going to have 4 shares after the split. And the stock price is also going to be split in from what was 1 share. It's going to be divided by 4. And if we do that on a share price around 100, your price is going to be about 25. And if we go look right here, I'm just going to pull up my brokerage platform here and pull up TPX. So you can see that the stock price has changed. They probably have a split adjusted chart here, and we want a time frame. So this chart hasn't been split adjusted, and you can see the price goes from clear up here down to way down here. So what happens is your 4 shares, they're worth the exact same amount as they were the day before. So they're worth about $100 a share. They're still going to be worth about $100, but it's going to be 4 shares now at $25 or around $25 instead of for 1 share at 100. So it gets split. So what happens to your option prices? They're going to make the exact same adjustment 2-year options. So if you had a 100 strike option and the price of that option was $1, or it was worth $1 at the close on the day before the split, the next day, your 100 strike shares, instead of having one of those contracts, so I said shares, one of those contracts, you're going to have 4 contracts, and the strike price is going to be divided by 4. So you would have 4 contracts at the 25 strike, if that's what you had before. Now, most of the time when you look at options strike prices, they're broken up on even numbers. So you'll get, a strike price every 5, every 10, every $1, and sometimes if the demand is high, every $1.50. You'll have a strike price at those regular intervals. And when there's a stock split and they have to split the price of that strike into whatever division, whatever the split is, in this case into 4, they have to take the strike. So the 25 strike was the 100 strike before. But if you had the 95 strike or the 99 strike, you divide that by 4. The next strike is not going to be an even number, because when you divide that by 4, it doesn't come out even, nice and even necessarily. And so you'll see we've got all these strike prices now, like 24.38, 23.75, 23.13, 22.5. They've all been divided by 4 as well. And so you have a new option price, and the price of that option is going to be whatever the price was before divided by 4. So if you had the 100 strike, the 120, the price at 120, the ask price at 120, or the bid price at $1, the bid price of the 100 strike before was probably $4, and the ask price is now was $4.80, but is now $1.20. So everything gets divided. So what happens when you have a credit spread and this happens to you? Your options get cut, they get divided by 4, and you'll end up with a position. Nothing's really changed. Your position is the same position you had, and when the stock price gets dropped, it should be just as difficult for those options. You should be at about, if you had a 90% probability, high probability trade in your credit spread before, you should still have about a 90% probability trade going forward. So it all depends on how the market interprets things, and changes happen over time, just like we always expect. But you're really in the same trade that you were in before. You just have 4 contracts at 1/4 of the price. Any questions?
Yes, Don here.
Yep.
How does that affect the spread? Say you had a spread of 3 points.
Yep.
How does the split affect that?
So it's going to be divided by 4 as well. So a 3-point wide spread before gets divided by 4. You're going to have a 75 cent spread now. Does that make sense?
Yes.
So you have a 75 cent spread at that point in time. After it's over, it was 3 points before, but you're okay. So your probability should be about the same. The amount of money that you have at risk is the same. The reward potential is the same, because you already collected that money. It just stays in your account. So everything remains identical. But the perception, when you talk about splits, sometimes people think, oh, when the stock gets split, it gets easier for more people and the stock gets more volatile. Sometimes maybe that's true, but also when you create more shares, it actually makes the one I want to talk about is Netflix, because I used to do earnings plays, straddle plays on Netflix all the time. If they had an earnings report coming up about 45 days in advance, I would try to buy a straddle trade for cheap, and that thing made a big move. And then they did a 4-for-1 stock split, and it was back in, I think it was 2017 when they did the stock split, and the the straddle trade stopped working. Why did it stop working? Because they had more shares available. It diluted the shares. And when you dilute the shares, there's more shares out there that are available, but volatility tends to go down. So when we're doing credit spreads, how do we make money in a credit spread? What is our goal? What do we want to see? What are we expecting? We're expecting volatility to stay the same or go down, and that's how we win. We're saying volatility is currently high. We're expecting that it's going to stay the same or go down, and we've got a really high probability of this target that we've got down here not getting hit. And so if you reduce volatility in the stock, that's actually going to be helpful towards your credit spread. So if you have more shares available and you dilute those shares, then it's going to be a little bit harder for the stock to make those big moves that might have triggered. So it's actually a good thing. It works out. It may not be good for future trades on that stock because it'll be harder for you to get a price that makes sense. But all in all, nothing's really changed. The shares have been diluted a little bit. Most likely volatility will go down, and that's that.